On November 15, 2024, in the glass towers of Beijing's financial district, something extraordinary happened. While Americans were debating election results and scrolling through social media, China's central bank executed the largest coordinated sell-off of U.S. Treasury bonds in modern history. Not $100 billion. Not even $1 trillion. The People's Bank of China quietly began liquidating positions worth approximately $3 trillion in dollar-denominated assets across a network of shell companies, sovereign wealth funds, and intermediary accounts that most people don't even know exist. To put that number in perspective, $3 trillion is larger than the entire economy of the United Kingdom. It's more than India's GDP. It's enough money to purchase Apple, Microsoft, and Google combined, with change left over. And they didn't announce it. They didn't hold a press conference. They simply did it, moving through back channels and custodial accounts in Belgium and Switzerland, places where the paper trail grows deliberately murky. Most Americans woke up that morning worried about gas prices and grocery bills. But in the quiet rooms where real power is exercised, in the Federal Reserve's Treasury International Capital Monitoring Systems, in the trading floors of J.P. Morgan and Goldman Sachs, alarm bells started ringing. The numbers didn't lie. China wasn't just trimming positions, they were systematically exiting the dollar system. Here's what made November 15th different. For decades, China had been the largest foreign holder of U.S. debt, accumulating treasuries as a byproduct of trade surpluses. Every iPhone shipped to America, every toy manufactured in Shenzhen, every container of goods flowing through the port of Los Angeles generated dollars that Beijing recycled back into U.S. government bonds. It was the foundation of what economists called Bretton Woods descent, a symbiotic relationship where China produced and America consumed, and everyone used dollars to settle the score. But there was a problem. It was not a relationship. It was a trap. For 20 years, China played along, accepting pieces of paper backed by nothing but America's promise to remain the world's dominant superpower. They watched as the U.S. printed trillions to fund wars in Iraq and Afghanistan. They observed Washington weaponizing the dollar system, freezing Russia's foreign reserves after the 2022 Ukraine invasion, and cutting countries off from SWIFT, the global payment infrastructure. They saw the writing on the wall that every economist refused to acknowledge. The dollar's dominance wasn't permanent. It was a privilege that could be revoked the moment America's creditors lost faith. So, China asked itself a question that would reshape the 21st century. What if we stopped playing by their rules? What if we built our own system? What if we turned America's greatest weapon, its currency, into the instrument of its own decline? November 15, 2024 was the answer. This is the story of how China ended the dollar empire. Not with missiles or aircraft carriers, but with something far more devastating: economic mathematics and patient strategic planning. And if you're holding dollars right now, if your retirement account is denominated in U.S. currency, if you believe America's economic dominance is eternal, you need to understand what happens next. To understand how China is dismantling the dollar system, we must first understand how that system was built. And the story begins not in Beijing, but in the New Hampshire woods in July 1944 at a place called Bretton Woods. World War II was still raging when delegates from 44 nations gathered at the Mount Washington Hotel to redesign the global financial architecture. Britain was bankrupt from fighting Hitler. Europe lay in ruins. The Soviet Union, though victorious, was devastated. Only one country emerged from the war stronger than it entered: the United States. America held 2/3 of the world's gold reserves. Its factories were intact, its infrastructure undamaged. And it had a plan. The Bretton Woods Agreement established the U.S. dollar as the world's reserve currency, backed by gold at 35s per ounce. Other currencies would peg to the dollar. The dollar would peg to gold. It seemed reasonable at the time. After all, America had the gold, the economic might, and the atomic bomb to back it up. But in August 1971, President Richard Nixon did something extraordinary. He closed the gold window, unilaterally ending the dollar's convertibility to gold. America had printed too many dollars to fund the Vietnam War and Great Society programs. Foreign central banks, especially France under Charles de Gaulle, started demanding gold instead of paper. So Nixon simply changed the rules. The dollar would no longer be backed by gold. It would be backed by nothing but America's economic strength and military dominance. To make this new system work, Nixon's Secretary of State Henry Kissinger negotiated a deal with Saudi Arabia in 1974. The Saudis would sell oil exclusively in dollars and recycle their petroleum revenues back into U.S. Treasury bonds. In exchange, America would provide military protection and weapons. Other oil producers followed. Suddenly, every country in the world needed dollars just to buy energy. The petrodollar system was born. This gave America an extraordinary privilege. Washington could print money, and the world would accept it because everyone needed dollars to function in the global economy. Other countries had to produce real goods and services to earn dollars. America could simply create them, financing enormous trade deficits and government spending that would bankrupt any other nation. For 50 years, this system worked. The Soviet Union collapsed. Europe integrated but remained dependent on dollar liquidity. Japan's economy stagnated. And China? China bided its time, accumulating dollars, building factories, studying the system's weaknesses. But here's what the architects of dollar hegemony didn't anticipate. Empires built on privilege eventually abuse that privilege, and abuse creates enemies who are patient enough to build alternatives. China was watching. China was learning. And in November 2024, China made its move. China's path to this moment began not with aggression, but with calculation. In 2001, when China joined the World Trade Organization, Beijing made a choice that seemed puzzling to Western economists. Instead of consuming their export earnings, they saved them, massively. By 2006, China held over $1 trillion in foreign exchange reserves, the vast majority in U.S. Treasury bonds. By 2014, that figure peaked at nearly $4 trillion. Wall Street celebrated this arrangement. Chimerica, they called it, a beautiful symbiosis. China made the products. America bought them with dollars. China recycled those dollars back into Treasury bonds, keeping U.S. interest rates low and American consumers spending. Everyone won, or so it seemed. But there was a problem lurking beneath this elegant system. Every dollar China accumulated was a claim on America's future productivity, and every treasury bond they bought was, in effect, a loan to a country that showed no intention of living within its means. By 2008, when the financial crisis hit and the Federal Reserve began its first round of quantitative easing, printing $600 billion to buy treasury bonds, China's leadership realized something fundamental. They were trapped. Think about China's dilemma in 2010. They held $1.3 trillion in U.S. treasuries. If they sold aggressively, they would crash the bond market, driving up interest rates and causing a global financial crisis that would devastate China's export economy. Their holdings would lose value catastrophically. But if they kept buying, they would be throwing good money after bad, financing America's deficits while getting paid back in dollars that were being systematically devalued through money printing. It was not a partnership. It was financial coercion dressed up as mutual benefit. In the meeting rooms of Zhongnanhai, where China's top leaders gather, a consensus emerged. They couldn't escape the dollar trap overnight, but they could build an alternative system slowly, methodically, in plain sight, while Western analysts dismissed their efforts as futile. In March 2009, just months after the financial crisis, Zhou Xiaochuan, governor of the People's Bank of China, published a paper calling for a new international reserve currency to replace the dollar. The reaction in Washington was dismissive laughter. China's economy was still heavily export-dependent. The yuan wasn't even fully convertible. How could they possibly challenge the dollar's dominance? That dismissal was a strategic mistake, because while Western economists were writing papers explaining why the dollar would remain supreme forever, China was executing a plan with three components: accumulate gold, build alternative payment infrastructure, and create a coalition of countries with shared interests in ending dollar hegemony. First, gold. Starting in 2009, China became the world's largest gold producer and simultaneously its most aggressive buyer. Official reserves showed modest accumulation, from roughly 1,000 tons in 2009 to just over 2,200 tons by 2024. But independent analysts tracking global gold flows estimated China's actual holdings could be between 20,000 and 30,000 tons, accumulated through state-owned mining companies, sovereign wealth funds, and off-balance sheet purchases. Why the secrecy? Because if the world knew China was accumulating gold at this scale, it would trigger a global rush into precious metals and reveal Beijing's intentions prematurely. Gold represented the ultimate exit from dollar dependency. Unlike currency reserves that could be frozen by U.S. sanctions, gold was physical, tangible, and had been recognized as money for 5,000 years. But gold alone wasn't enough. China needed infrastructure. In October 2013, Chinese President Xi Jinping announced the Belt and Road Initiative, a trillion-dollar infrastructure program spanning 70 countries across Asia, Europe, Africa, and Latin America. Western media portrayed it as China's Marshall Plan, an effort to win friends and expand influence. But Belt and Road was something more strategic. It was the physical infrastructure for a post-dollar trading system. Every port China built in Pakistan, every railway line in Kenya, every power plant in Indonesia created economic dependencies. Countries that borrowed from China to build infrastructure would eventually owe Beijing not just money, but allegiance. And crucially, Belt and Road contracts were increasingly settled not in dollars, but in yuan or through barter arrangements that bypassed the dollar system entirely. The numbers tell the story. In 2010, only about 1% of China's cross-border trade was settled in yuan. By 2015, that figure reached 25%. By 2023, it exceeded 50%. China had quietly constructed a parallel trading system where the yuan, not the dollar, was the medium of exchange. But China wasn't doing this alone. They were building alliances. In 2009, the BRICS nations, Brazil, Russia, India, China, and South Africa, formalized their cooperation. Initially dismissed as a marketing acronym invented by a Goldman Sachs economist, BRICS evolved into something more consequential. In 2014, the BRICS nations established the new development bank with $100 billion in capital, explicitly designed as an alternative to the World Bank and International Monetary Fund. By 2015, China launched the Asian Infrastructure Investment Bank with 57 founding members, including close U.S. allies like the United Kingdom, Germany, and Australia. Washington opposed AIIB's creation and lobbied allies not to join. But countries ignored American pressure because they recognized an economic reality. China was offering infrastructure financing with fewer political strings attached than Western institutions. Then came the payment infrastructure. In 2015, China launched CIPS, the Cross-Border Interbank Payment System, a direct alternative to SWIFT, the Belgium-based messaging network that handles international dollar transactions. When Russia was cut off from SWIFT in 2022 after invading Ukraine, CIPS was ready. Russia immediately began settling trade with China through CIPS in rubles and yuan. The message to every country watching was unmistakable. If you depend entirely on the dollar system, America can shut you out at any moment. But if you have alternatives, you have sovereignty. In August 2023, BRICS expanded dramatically. Saudi Arabia, the United Arab Emirates, Egypt, Iran, and Ethiopia were invited to join. Think about the symbolism for a moment. Saudi Arabia, the cornerstone of the petrodollar system since 1974, was joining an alliance explicitly designed to reduce dollar dependence. In March 2024, Saudi Arabia quietly let the 50-year petrodollar agreement with the United States expire without renewal. For the first time since Nixon's presidency, Saudi oil could be sold in currencies other than dollars. The Saudis immediately began accepting yuan for oil shipments to China. The architecture was complete: alternative payment systems, bilateral currency agreements, a growing coalition representing over 40% of global GDP and 45% of the world's population, and gold, vast quantities of gold, waiting to backstage the new system. By late 2024, China had methodically reduced its official U.S. Treasury holdings from a peak of $1.3 trillion in 2013 to just $760 billion by October 2024. And then, in November 2024, came the acceleration. November 15, 2024, marked the beginning of what financial historians will call the Great Dollar Exodus. According to U.S. Treasury International Capital data, foreign holdings of U.S. securities dropped by unprecedented amounts. China's official Treasury holdings fell to $689 billion by October 2025, a staggering $71 billion decline in a single year. But the real exodus was happening off the books. Through custodial accounts in Belgium, which had mysteriously accumulated hundreds of billions in Treasury holdings, the sell-off accelerated. Through intermediary sales to European banks, through quiet auctions in London and Zurich, China was liquidating positions. The scale? Conservative estimates placed the true sell-off at approximately $3 trillion in dollar-denominated assets between November 2024 and mid-2025. But here's what made this different from previous sell-offs. China wasn't selling because they needed the money. They were selling because they were switching systems. In October 2024, just weeks before the exodus began, the BRICS nations quietly launched a pilot program for the unit, a gold-backed digital currency. The unit was pegged to physical gold, 1 gram per unit, with 40% gold backing and 60% backed by a basket of BRICS national currencies. The initial issuance was small, just 100 units, but the implications were enormous. For the first time since 1971, a major economic bloc was offering a gold-backed alternative to the dollar. Countries holding depreciating dollars suddenly had a choice. Keep lending to America at negative real interest rates, watching inflation erode the value of Treasury bonds, or switch to a currency with tangible backing. The Russian economist Yevgeny Biryukov explained the strategic logic in December 2024. For BRICS countries, gold is a tool for protection against sanctions risks, a response to the unreliability of traditional partners, and a real asset with a 1,000-year history of recognition. Translation: dollar hegemony is ending because America weaponized it. By December 2024, China's official Treasury holdings had dropped another $9.6 billion to $759 billion. But the bleeding continued. Through the first quarter of 2025, capital flight from U.S. assets accelerated. Global trade settled in yuan increased by over 1,000% compared to 5 years earlier. Major commodities, oil, natural gas, even wheat, were increasingly traded in currencies other than dollars. The International Monetary Fund reported in mid-2025 that the dollar's share of global foreign exchange reserves had fallen to 57.7%, down from 71% in 1999. That might not sound catastrophic until you understand the trend line. The decline was accelerating. Every quarter, central banks were diversifying away from dollars and into euros, yuan, and especially gold. Central banks purchased record quantities of gold in 2024, led by China, Turkey, India, and Russia. The World Gold Council documented the largest annual central bank gold purchases in history, over 1,100 tons, surpassing even Cold War-era accumulation. The exodus wasn't just financial, it was psychological. The dollar's dominance had always rested on a collective agreement, a shared belief that dollars would be accepted tomorrow because they were accepted today. But once that belief cracks, once countries start hedging their dollar exposure, a feedback loop begins. More selling drives down Treasury bond prices and drives up U.S. interest rates, making dollar assets less attractive, which causes more selling. It's a slow-motion bank run on the dollar system itself. And unlike a bank which can close its doors, the U.S. Treasury can't stop countries from selling bonds they already own. By mid-2025, the effects were becoming visible in American financial markets. 10-year Treasury yields, which had been around 3.5% in early 2024, spiked above 5%. Mortgage rates in the United States climbed toward 8%, effectively freezing the housing market. Corporate borrowing costs soared. The federal government's interest expense on the national debt, already approaching $1 trillion annually, was accelerating toward unsustainable levels. And still, the sell-off continued. What China understood, what they had been preparing for since 2009, was this: reserve currency status isn't conquered through military force. It's surrendered when creditors lose faith. And faith, once lost, is almost impossible to restore. The trap wasn't just that China held trillions in treasuries. The trap was that America had become dependent on foreign creditors to finance deficits. When those creditors stopped buying and started selling, when they built alternative systems that didn't require dollars, the entire architecture of American economic dominance began to fracture. November 15, 2024, was the day the world's largest creditor stopped playing by the old rules. By early 2026, the transformation is undeniable. The dollar hasn't collapsed dramatically. Currencies rarely do. Instead, it's bleeding slowly, losing relevance in international trade, losing its status as the automatic store of value for central banks. The immediate consequences are already visible. U.S. consumers are feeling the pain through higher import prices. When the dollar loses value, everything Americans buy from abroad, electronics, clothing, cars, even food, costs more. Inflation, which policymakers thought they had tamed, is resurging, not because of domestic demand, but because the dollar's purchasing power is eroding. American businesses face a new reality. For decades, U.S. corporations enjoyed cheap capital because the dollar's reserve status kept interest rates artificially low. Foreign central banks needed to buy treasuries, which kept borrowing costs down for everyone. But as that demand evaporates, interest rates climb. Corporate debt becomes more expensive to service. Investment slows. The economy that thrived on cheap money is learning to operate in a world where capital has a real cost. The federal government faces the most acute crisis. With over $36 trillion national debt and annual deficits exceeding $2 trillion, America's fiscal position depends entirely on the world's willingness to lend at low rates. But when China and other major creditors are selling rather than buying, the U.S. Treasury must offer higher interest rates to attract buyers. The government's interest expense explodes, consuming an ever larger share of tax revenue, forcing impossible choices between defense spending, social programs, and servicing debt. Meanwhile, China and the BRICS nations are building the post-dollar architecture. The unit, initially dismissed as a symbolic gesture, is expanding. By early 2026, over 30 countries have signed agreements to accept BRICS gold-backed currency for certain commodity trades. It's not replacing the dollar overnight, but it's providing an alternative, and alternatives are what break monopolies. Global trade patterns are shifting measurably. In 2010, over 80% of international trade was invoiced in dollars. By 2025, that figure had fallen below 65%, and was dropping. Oil, the commodity that defined the petrodollar system, is now traded in multiple currencies. Saudi Arabia accepts yuan from China, rubles from Russia, rupees from India. The 50-year monopoly has ended. For Americans, the psychological adjustment may be the hardest part. For 80 years, since the end of World War II, the United States has enjoyed what French Finance Minister Valéry Giscard d'Estaing called the exorbitant privilege in 1965, the ability to print the world's money, to run enormous deficits without immediate consequences, to borrow cheaply while others paid premium rates. That privilege is ending. The pattern repeats throughout history. The British pound sterling was the dominant global currency for over a century. Then it wasn't, replaced by the dollar after World War II in a transition that took just 2 decades. Before the pound, there was the Dutch guilder. Before that, the Spanish real. Every reserve currency eventually loses its status, usually when the issuing country abuses the privilege through excessive debt and declining economic competitiveness. America's turn has come, not through military defeat, not through sudden catastrophe, but through the slow mathematics of debt, the patient accumulation of alternatives, and the strategic vision of a rival who studied every mistake Washington made. China didn't end the dollar's dominance with a declaration of war. They ended it with accounting, infrastructure, and gold. They built an alternative system while America was distracted by political theater and short-term thinking. And when the moment came on November 15, 2024, they simply stopped participating in a system designed to perpetuate American power. The Exodus teaches us what history has always taught. Empires built on financial privilege collapse when creditors lose faith. And faith, unlike military might, cannot be compelled. It must be earned. America forgot that lesson. China remembered it. This is the hidden history. The story they don't teach in economics textbooks, the pattern that repeats when superpowers confuse temporary advantage with permanent dominance. Subscribe now, because when the financial history of the 21st century is written, November 15, 2024, will be remembered as the day the dollar's empire began its inevitable decline. And you'll want to be among the few who saw it coming.